throughout my career, the vast majority, particularly our most successful investments, have been ones that have been controversial in one way or another.
Today, we're trying to learn from Bill Ackman, one of the most successful investors over the last decade, and also at the same time look into his biggest holding at Pershing Square, and that would be Uber stock, to see, is Uber a buy? Is there a good reason to invest in Uber right now? Before we get to that story, let's do the weekly update on the growth on sale portfolio. And I have just added the name Kimberly-Clark, which is a consumer discretionary company doing things like toiletries, all that for big businesses as well as individuals. Now I've added this to the growth on sale mainly because of its dividend, and that adds a layer of safety to the portfolio. Even though we all like to be aggressive with our portfolio, make a bunch of money, beat the S&P 500, it's this ability of adding safety to a portfolio that will allow us to do that. So make sure to subscribe and follow the journey of the portfolio. Otherwise, we'll get through to the main story here, looking at Bill Ackman.
Richard Rainwater is one of the great investors of all time. He came to speak at Harvard Business School when I was a student. I was thinking about starting my own investment firm, and I asked Richard what he thought of the idea. He said, "You know, Bill, you don't need to be old to be right." That was enough for me.
He was born in 1966, making him 59 and one of the younger billionaires in the world, especially because making his money through investing, it takes a long time to get there. So pretty impressive for his age. Now, he actually started his first investment fund called Gotham Partners, which was a bit of a disaster in 1992. And that led to the company actually going bankrupt, going out of business, with one of his biggest losses investing in golf, which was through the company name Gotham Golf. Just like Bill Ackman, we should all learn from our mistakes, and that's when he started his next fund, which was Pershing Square, almost straight afterwards. He adapted himself and looked at what were some investing methods that worked in the long run, and that always comes back to value investing.
We like businesses that we call them simple, predictable, free cash flow generative, dominant companies, businesses with a moat around them. And the way we make these decisions is we do our analysis. And then we look for a company you can buy at a very deep discount to what it's worth.
And then he also makes the decision, just like many of us retail investors, he chooses to not have too many companies. So if we can manage to keep our total portfolio under around 20 companies, that just means that we don't get overwhelmed with the amount of information coming to us. We can always stay up to date on all of our different investments. And this is where Bill Ackman starts to experience a lot of success. And just looking at a few examples here, we're going to see it doesn't take anything grand spanking new, brand new technology to make a bunch of money. It's all about buying companies that are on sale and then having, the convictions to hold onto them for a decent amount of time. For example, one of the earliest wins from Bill Ackman was owning Canadian Pacific Railway, which operates also in the United States. So Ackman replaced the CEO, which we wouldn't be able to do that, but he slashed inefficiencies, got involved with the company, and maybe the company would have performed well anyway, but he managed to get a 270% return in the stock over a period of about, 5 years. One more example where Bill Ackman wasn't so intrusive was investing in the name General Growth Properties. Now, this is the second biggest mall operator in the United States, and they went through a bankruptcy type process. They still managed to hold on to the company and remain publicly listed, and Bill Ackman bought into General Growth Properties right around the big crash in 2008, and then he only held for a few years, around 100 timesing his investment. And the final case study we're going to go through was actually in 2020, and this reveals kind of the dark side of Bill Ackman that I think is very fair to mention. So during the early months of 2020, with the peak of the fear about the coronavirus and lockdowns, all that stuff, Bill Ackman was on the TV telling everyone this is going to be a financial and economic disaster for the entire world, and pretty much implying you should sell all of your investments.
The only answer for the world is to shut the world for 30 days. And the Chinese are incredibly disciplined. They wear masks. They practice social distancing. It kills, 1 to 2% of the people. In China, the number's been closer to 4. I have a father who's almost 81. He had lung cancer. He lost 2/3 of his lung capacity as a result of surgery.
And during this time, Bill Ackman directly profited from people selling off their shares and people souring on the economy. He owned a short bet against corporate debt. In other words, he profited as people priced in bankruptcy in corporate America, and he managed to net $2.6 billion in just a few weeks. At the same time, if you followed Bill Ackman directly, you maybe sold off all of your stocks in the peak of the hysteria and the negativity, maybe losing around 30% of your portfolio. Or if you held more risky companies, you could have been down 40, 50, 60%. And from those case studies, we have 2 more lessons. So you get rewarded when you make a calculated bet and when you buy companies that are undervalued. And the last lesson was we really can't trust these big investors and their words. We have to look at their actions. Where is their money actually sitting and how are they making their profit? And we are going to do just that in this video. We're going to look at Bill Ackman's direct actions. We can look at his first quarter 13F filings, telling us directly what public companies he owns.
We like businesses that we call them simple, predictable, free cash flow generative, dominant companies, businesses with a moat around them. And the way we make these decisions is we do our analysis. And then we look for a company you can buy at a very deep discount to what it's worth.
Running through Ackman's top investments, yes, we have Uber, already mentioned that. We're going to go deep into Uber for the rest of the video, but just going through a few others. We have Brookfield, which is an asset manager, kind of similar to BlackRock, second biggest position. Google, third biggest position. Everyone knows Google. And Chipotle coming up on 5th biggest. But also we can see he's backing up his stance about concentration. Out of those 3 names we just mentioned, excluding Uber, that's 41% of the company. Including Uber, we're looking at around 60% in just 4 companies. And I'm a big fan of this concentration as long as we still have companies that are different in nature. And I've done that myself in that model portfolio at the start of the video. It might be really weird. We have a healthcare insurance company, we have Google, and then a consumer discretionary toilet paper and washing soap company. But it's really the different nature of the businesses that adds true diversity in a portfolio. If we had 100% tech companies, but we had 200 of them, that's actually less diversified and less safe than 3 companies in 3 different entire fields. Doing the research for this video, I actually found a bit of a diamond in the rough. Didn't realize that this company was going to be so high quality for a good price. And that was Uber stock. Uber, since its public offering, has been quite a expensive company in valuation, or it's been unprofitable, both things that I do not like to invest in. But over the last year, Uber stock, with its fear of self-driving cars and robo-taxis, has become very, very cheap. If we just follow analyst expectations, if we look at the full year 2026 earnings, the company is currently priced at a P ratio of 27. That's not an extremely aggressive valuation. I would actually say that's fair value, but as always, we need to double check the analyst story to see, are those expectations of profits reasonable? Or is Uber actually going to overperform expectations? The easiest way we can see this is looking at the income statement from Uber, looking at the first quarter this year, and they just compare it year over year to 2024. Now, looking at this first section, they show us there are 3 different main segments of the business. We have mobility, which is Uber taxis, delivery, which is more of the food and grocery delivery, and then we have freight, which is actually doing deliveries for e-commerce businesses and things like Amazon. The revenue growth for these segments is lining up really nicely. And what I mean by that is, yes, the first 2 segments, so the taxi and food delivery, is averaging around 16% yearly revenue growth, and that should continue moving forward. However, we have freight, which is actually down 2%, over a year. But when we look at the adjusted EBITDA margins, we see here the only part of the business that is losing money still is the freight. So that's actually a good thing in a sense, that the money-making segments are growing the fastest. So over time, the profit margins for the entire business should be improving if they stay stable. But I would say that margins are probably going to continue marching up higher and higher. Over the last year, profitability for the taxi business went from 23% to now 27%, and then for delivery of food, that went from 16% to 20%. But I'm starting to get to the point with Uber Mobility and also delivery that those profit margins are starting to approach their maximum. How profitable can Uber be when it still needs to pay drivers? You get to the point where profit margins start to slow down, they reach their theoretical maximum, and most of your overall bottom line profit growth will come from revenue growth and also share buybacks. And unfortunately for Uber so far, they aren't doing any share buybacks. But it's when we put this entire story together, looking at the expanded income statement, that the bullish story of Uber is just starting to begin. If we straight away look at the profit for Uber per quarter, taking into account everything, none of this adjusted business, last year they actually lost $654 million. That's quite a big loss in a quarter, and not many people want to invest in a profit-losing company. But Uber has transformed over the last year, making a solid profit now of $1.7 billion US. There are a bunch of short-term profits that just won't happen again. So to be fair, the profit number per quarter should be around $1.2 billion. Now, the good news from Uber, if they can continue growing revenue at 16-17% per quarter, that's about $2.5 billion. Now, assuming that about half of that goes to the driver, and they're keeping a lot of the other costs of the business in line, like sales and marketing, research and development, those are not aggressively going up $1 billion every quarter. What that tells us is around 40%, 50% of that revenue growth is going straight to the profit margin. That accounts to around $1.20 per share growth in EPS per quarter moving forward. So if we zoom forward a year, then we could say that perhaps we're going to double our earnings per share, and then the year after that, maybe see an increase of 50%, and then slowly it will keep going down. But there's a real beautiful moment when these public companies start to transition to being profitable. You can see a massive gain in growth in profits, and that's a really good opportunity to start investing, especially when the valuations are so cheap. For example, if we take an earnings per share for next year at around $6 EPS, now that could be fair, that could be too aggressive, but that would price the company at around 15.5 forward PE ratio. Now, for a company that is growing so strong, 50% maybe earnings growth if we average out over the next couple years. Now, I just wanted to address the biggest negative of Uber. There's a giant competitor that's been introduced to the market over the last couple years.
Tesla's first robo-taxis are officially on the road.
First Tesla robo-taxi ride.
Elon Musk's company launching its long-awaited self-driving taxi service in Austin, Texas, offering rides to a select group. The cost, a flat rate of $4.20 per ride. For now, the service is limited to a handful of cars in a small area of the city, but Musk has big ambitions, not just for robo-taxis, but for every Tesla.
By the end of next year, we'll have hundreds of thousands, if not over 1 million Teslas doing self-driving in the US.
But there has been reported mistakes with the robo-taxi. So straight away, Tesla, over the next couple years, I don't think is a major issue for Uber, especially if you view Uber as the worldwide business that it is. Tesla's probably at least a decade away from really impacting Uber's business. Now, the major competitor worth worrying about is actually Google's Waymo. They've been operating as a self-driving taxi service, so there's no driver in the car, for a couple years now. And we can just have a look at the market share story developed in San Francisco. This is a really good place to look because that's where Waymo began. This is really projecting to us about a decade ahead into the future for the rest of America. In San Francisco, Waymo has stolen 25% of the market share, with Uber having 55% and Lyft having 20%. This is extremely dangerous for Uber in terms of a revenue story. So if you have a loss of market share, that directly affects obviously your revenue, but it also makes it harder for the rest of your business to charge high prices, higher margin. And Wall Street has likely cut the valuations of Uber down, I reckon around 30%, because of this one major competitive risk. And that's not even addressing the fundamental issue of profitability. If you have the entire industry all of a sudden get used to driverless taxis, is that going to drive down the cost that Uber can charge for a ride? Now, that's actually what I thought was the biggest issue, but if we dive in a bit deeper, we again have the case study with Waymo versus Uber, and we've actually found that Waymo charge around 31% to 41% more than Uber for the same type of ride. I did scrape this from Google's AI, but they have stated something that makes sense, and that is a lot of people are preferring the driverless car, so they're actually willing to pay a bit more. This could be in terms of privacy, but also maybe safety. So there is a hope that Uber can almost establish itself a big part of the market and maintain it, and then driverless cars are almost going to form their own industry. Some people will just always prefer having a human in the car. I'm thinking of my parents and my grandparents' generations, and then you might have more younger people that would prefer the driverless model. Looking at the price chart of Uber stock, it seems like if you bought in at the April lows, you could have bought this company at a forward P ratio of something like a 12 if you do your own profit projections. If you used analysts, you probably bought it for like a 17 forward P ratio. Either way, the company looks a steal at those prices. However, it's too late for me. I only found out about this company about a week ago, and the price has shot up 44% from those lows. Let me know what you think of Uber stock. Do you think it's a buy, or should we stay away at these prices? Thanks for your time, guys. Make sure you subscribe if you haven't. See you next time. Bye.